Hello, welcome back to Financial Management. So in this part of our lecture, we're going to go through capital structure with taxes. And just to orient where we are, so far we've established that capital structure can be irrelevant when there's no market frictions. So our last lecture introduced capital structure, the mix of debt and equity. We showed that that mix of debt and equity does not affect firm value when there are no market frictions. But when we do have market frictions, like taxes, bankruptcy, agency, information asymmetry, incomplete contracting, the list goes on, then that capital structure will add or decrease firm value depending upon how we mix it. So without market frictions, leverage increases the expected return on equity, not on assets. And the key idea there was that as the firm uses more debt, it's going to become a bit riskier in terms of equity, but that will not affect the return on assets. How I finance the project will not affect the expected cash flows for the project. Okay, this half, we're going to look at one market friction, which is taxes. And the main punchline is going to be that because firms' tax payments, because the interest payments on debt are tax deductible, there will be a tax shield, and that tax shield will be valuable. So if we return to our present value equation, as we established, we've got our free cash flows divided by our cost of capital. And when we go through these different ways of valuing this tax shield, we'll first do an adjusted present value, which puts that tax advantage in the free cash flow, the numerator. And then we'll look at a whack with taxes, in which we change the discount rate to increase the present value of the firm given this tax advantage of debt. Let's take a look at capital structure by country. So this is from Fan et al., and it looks at the median leverage ratio by country. What you'll notice is that there's quite a bit of variation across countries, meaning that there's not one specific level of capital structure or of leverage that we observe that firms all around the world have. So what can we see in those patterns? If we look, we'll notice that countries with higher dividend tax rates contain firms that use more debt. Countries with higher inflation contain firms that use less debt, and countries that are perceived as more corrupt contain firms that use more debt. Now, obviously, it's intuitive that given these patterns that we observe in the data around the world, that there are market frictions that are at play. So with countries having a higher dividend tax rate using more debt, that's straightforward. If the payouts to investors that come in the form of dividends are going to be taxed at a higher rate, then it's logical that the firm would use more debt. And we'll get into that when we look at the tax shield. If the country has higher inflation, then it's logical that the firms would use less debt because the debt itself is going to be eroded in value. If you remember from our very first lecture, we were looking at the set of things that can affect actual value for debt. And then lastly, with corruption, if the firm is perceived as more, if the firm is in a country that is perceived as more corrupt, as an equity investor, I'm going to want to make sure that I get the cash out of the hands of managers. So one of the ways that I can do that is by having the firm lever up. And sometimes people will refer to this as the discipline of debt. The idea being that if managers have a big debt payment that they have to make consistently, there's less free cash flow for managers to waste or to use on themselves, and etc. So what's the big punchline? The big punchline is that when we look at these patterns around the world, it suggests that these frictions do in fact matter for capital structure. What we're going to focus on is taxation. So interest payments on debt are tax deductible, while dividends paid to stockholders are not tax deductible. That tax deductibility means that as a firm, when I'm looking at the actual income that I have to report, and from that income, I have to pay a proportion of tax, I'm going to pay less, all things held equal, if I'm financed with some debt. So if we decide to finance our company with mostly debt, we would save a lot of money on our tax bill because the interest payments are tax deductible. The tax deductions on interest are known as tax shields. And these tax savings are passed on to shareholders, assuming, of course, that the bond payments have been fully covered, which is going to be typically true. So let's think about the value of the firm in terms of the allocation of what's going where. We can think of the firm as a pie that gets sliced up between bondholders and stockholders. However, with taxes, the government is also going to get a piece of that pie. Logically, If the firm value is created by us giving a smaller slice to the government, i.e., by us paying less tax, then there's more value for bondholders and stockholders. And of course, bondholders and stockholders are going to be willing to pay more for a larger slice of the pie. Thus, we can increase firm value by reducing our tax liability through tax shields. So more debt implies a smaller slice for the government because of the tax deductibility of interest. So let's look at two firms. These two firms both have an operating income of 1,000, and we can observe that there's a tax rate of 40%. So what do you see? You see that firm A, the unlevered firm, has all of this income, but is paying proportionately more in taxes. Firm B is levered, meaning that firm B is financed with debt and equity. The cash flows go to debt and equity holders, and it's paying less tax. The difference in the amount of tax paid between firm A and firm B, these are identical firms. The difference is that one is unlevered, i.e. all equity, and one is levered, i.e. it has some debt. The difference in those tax payments is the tax shield. So we'll do an example to calculate it out, but this is so we can get the concept at least graphically. Example one, two firms have identical assets and will both produce a 1,000 cash flow before tax and interest next year. Firm A is all equity. Firm B has an 8K and has 8K in par bonds outstanding, where the annual interest payment on these bonds is 5% per year. The tax rate is 40%. What is the cash flow to equity holders for firm A? So as we do this, we know that this cash flow is before tax and interest. So we've got 1,000 that comes in, and it's very straightforward. We can take our 1,000, we can multiply that by the tax rate, and it's clear that as an equity holder, my cash flow will be 600. Part B, what is the cash flow from the tax shield for firm B? When we're calculating the cash flow for a tax shield, there are going to be two components. First, we're going to take our bond and then look at the interest that's paid on that bond, and then we're going to multiply that by the tax rate. The reason why we're doing that is because the tax advantage, the tax deductibility, is on the interest payments. So in this example, our bond is going to have an interest payment of $400. So that $400 in interest is then going to be multiplied by our 40% tax rate. So that's going to be how we find our tax shield for firm B, the cash flow from our tax shield. What are the cash flows to equity and bondholders for firm B? So let's do this in two steps. First, we've got our $1,000 cash flow that comes in. Second, we've got to minus our interest payment to bondholders. So we know that our bondholders are going to get $400 and our equity holders are now going to get $600. But from that $600, we also have from that $600, we also have to take into account our taxes. So that $600 is going to be $600 multiplied by 40%. 600 less 240 is going to be the cash flow to equity holders. What's going to go to bondholders? Bondholders are going to get the $400 in interest payments. So what is the total cash flow to all investors in firm B? As you solve this, as you set this up, what will you notice? You'll notice that in firm B, the equity investors are getting less than they would under the example of firm A, but we also have bond investors that are now getting paid $400, whereas in firm A, there was no payment to bonds because it was an all equity firm. So what's the big punchline? When we add up the total cash flow to all investors and we compare it in firm A, that was all equity, to firm B, that's equity and debt, we observe that in firm B, there's a larger cash flow going to all investors. And that cash flow, the increase in cash flow, is precisely driven by this tax shield. Because interest on debt is tax deductible, the value of the firm now will depend on capital structure. So more debt is going to imply a higher tax shield. In the previous bar graph and example, 60% of asset cash flows went to investors in the all equity firm, our unlevered firm, which was firm A, while 76% of asset cash flows went to investors in the levered firm. And remember, investors include both our debt and equity holders. So our next challenge is to find the value of the firm when capital structure is taken into consideration. There are going to be two ways that we can look at this. The two main ways are going to be the adjusted present value, the APV, and the WACC with taxes. We'll go through both procedures in quite some detail. So the main idea behind the adjusted present value is that the value of the levered firm, the firm that's using debt, it's going to equal these two things: the value of the unlevered firm, so i.e. if it were an all equity firm, plus any additional effects due to capital structure, the net present value of its financing. Now, the net present value of financing takes into account present value of tax shields. It also will take into account the present value of expected bankruptcy costs and mispricing of securities, which are two things we're going to get into when we get into our next set of lecture material. So let's look at this APV. For now, we'll focus on the present value of tax shields. So we've got on the left-hand side, the value of our levered firm. And on the right-hand side, we've got the value of the unlevered firm plus the present value of tax shields. A tax shield cash flow in year T is going to equal our interest payment multiplied by our tax rate. And this is what we did in our first example. Interest payments can be calculated by multiplying the face value of debt by the expected return on debt. And we will almost always assume that the debt is issued at par, meaning the face value of the debt will equal the actual debt value of D. So we could think of our interest payments as D, the actual face value of the debt, multiplied by the expected return on debt, and then we're going to multiply that by the tax rate to get our tax shield. Okay, when calculating the present value of tax shield cash flows, what discount rate do we use? This is a non-trivial question. In our class, we're going to use the expected return on debt, as the riskiness of those debt payments are tied directly to the riskiness of the tax shields from those debt payments. There are other ways to do this, and arguably one could argue that you should be using the expected return on assets, but that's a little bit advanced for this course, so we're going to keep it simple. We're going to use the expected return on debt. Let's do an example. Suppose a firm sells a bond for $1,000. The firm must pay interest of $50 per year for 10 years and pay back a face value of the $1,000 in year 10. The debt has a discount rate of 5%. Our first question, is the bond fairly priced? So to answer this question, we're going to set up a present value formula. We've got the $50 that are paid. We know the discount rate is 5%. This is just like doing an annuity that's going to last for 10 years. Plus, we have to take the present value of our final par payment, the $1,000. So it's going to be 1,000 divided by 1.05 to the power of 10. When we do the math and solve for it, we're going to find the present value of those future payments, and that is the bond price. So what do we notice? Well, when you do part A, you'll observe that the bond is fairly priced, meaning that the bond selling for 1,000 and the present value of these future payments is also 1,000. Assume a debt discount rate of 5% and a tax rate of 40%. What is the value of the tax shield? Note that the face value repayment is not tax deductible. So as we do part B, notice that in part A, as you valued the bond, you'll have these two components. You'll have the present value of the actual coupon payments, which again is just like our annuity formula, plus the present value of that final par payment, the $1,000 that's paid back in year 10. So how are we going to do this? What we're going to do is we're going to take our annuity payment, that $50 that's given every year for the next 10 years that has a discount rate of 5%, our coupon payments that we set up like an annuity, and we're going to multiply that by 0.4, by the tax rate. Why are we doing that? We're doing that because we want to get the present value of our interest payments and then multiply that by our tax rate to actually get the value of the tax shield. Remember, it's the present value of all of these cash flows that are tax deductible multiplied by the tax rate. That's how we're going to get the present value of our tax shield. Suppose the bond is perpetually outstanding, meaning that the bond is now going to be basically a perpetuity with these coupon payments. what is the value of the tax shield? The way that we'll do this is we'll do this in two steps. First, to get our interest payment, we've got the value of the bond, 1,000, multiplied by our, our rate on the bond, the 5%. So we have that multiplied then by our tax rate, which is 40%. Now, if this is a perpetuity, that $1,000 multiplied by the rate on the bond, the 5%, and the way that I'm getting that is because the interest payments on the bond are going to be $50 per year. So what do we have? We've got our 1,000 multiplied by 0.05 multiplied by 0.4. If this is a perpetuity, then those cash flows are going to go on just like a perpetuity. And if I discount this as a perpetuity, I've got the face value of the debt multiplied by the interest multiplied by the tax rate, all of that divided by the discount rate. So automatically, when you set this up, you'll notice that the rate in the numerator and the discount rate in the denominator are going to cancel right out. That means that I'm left with the face value of the bond multiplied by the tax rate. And we can only do this if the bond is being held as a perpetuity, meaning that the debt is just constantly going to roll over. It's basically a perpetuity. So example 2C will illustrate how you can calculate the value of the tax shield when the debt is held in perpetuity. We've got our tax rate multiplied by the level of the debt. When the firm maintains the same level of debt, D, in perpetuity, the value of the levered firm simplifies to the following if the tax is the only market friction. So if the only market friction that we have is tax, then the value of the levered firm is going to equal the value of the all equity firm and unlevered firm plus the face value of the debt multiplied by the tax rate. Now, if we have additional market frictions that will affect the other way that we think about the present value of financing, we're going to have to put more into the equation. But for now, when it's only debt that's held in perpetuity, it's really simple. We take the face value of the debt and we multiply it by the tax rate. We add that back to the value of the firm, and we've now got the value of the levered firm. What we notice when we have VL on the left side equal to the value of the unlevered plus the tax rate multiplied by the face value of debt, what you can see is that if the tax rate were 0, then the value of the levered firm would equal the value of the unlevered firm, which is exactly what we get from the original M&M proposition. Example 3. Your firm has $100 million in perpetual risk-free debt outstanding and does not plan to change this debt level. Your firm's operating assets will produce $20 million in free cash flow in perpetuity starting next year. The beta of these operations, the beta of the operating assets is 1.5. The market risk premium is 8%, and the risk-free rate is 3%. The tax rate is 40%. First, what is the value of your operating assets? So as we set this up, this is just straightforward like we've done before. What do we have? We have enough to actually calculate the discount rate for our CAPM. Why am I saying that? I'm saying that because we know the beta of our operating assets is 1.5. We know our market risk premium, i.e. RM minus RF, is 8%, and we know the risk-free rate. We can throw those in and get our discount rate for the CAPM. Okay, so what do we need to do? Well, we know that the firm's operating assets are going to produce $20 million in free cash flow in perpetuity. So we can take our $20 million and divide that by our discount rate. Part B, what is the value of your tax shield? Okay, the firm has $100 million in perpetual risk-free debt outstanding. So that $100 million is going to be rolled over and over again. And what's nice is when it's a perpetual debt, when it's perpetual debt outstanding, we can take the face value of that debt, the 100 million, and then multiply it by our tax rate, by the 0.4, the 40%. Using the APV, calculate the value of your firm. So as you set this up, on the left-hand side, you'll have the value of the levered firm. And on the right-hand side, you'll have equal to the value of the unlevered firm plus the present value of this tax shield. And we just did that step by step. To value the unlevered firm, we're going to take the operating cash flow, the 20 million, and we're going to divide that by the CAPM implied discount rate, because we're going to treat that as a perpetuity. And to get the value of the present value of financing, in this case, we can take the face value of the debt, the 100 million, and multiply that by our tax rate, because the debt is going to be held in perpetuity. So that's how we set it up, and that's how we solve for it. A few more points. The top expected marginal tax rate, marginal income tax rate, is typically used in these calculations. Now, of course, this is an expected tax rate applied to one additional dollar in taxable income in the top tax bracket. We assume the firm makes enough money so that it's in the top tax bracket. But we're going to notice that we're using the word expected. If the top tax rate is expected to increase next year or any other future year, then you must apply the expected tax rate to those corresponding future cash flows. And the reason why you want to do that is because we're taking the present value of those expected tax payments. So if I expect that taxes will be higher, then I need to use a higher tax rate. More notes. Tax shields are applied against your current tax bill to make your bill cheaper. In real life, tax shields can be applied to tax payments dating back 3 years. And this cannot be done. If there's no tax bill in the past 3 years, then you can do a carry forward. So you'll hear sometimes in financial press discussions of tax law or discussions of changes in taxes with a carry back or a carry forward. And this is exactly what it's intending, what it means. If I can use this tax shield and apply it to my taxes that I've paid before, then I can carry it back. And if not, then I can carry it forward. So these carried forward tax assets, you have to report them on the balance sheet, and the firm has to reasonably believe that it will use them in the future. This is not a course on tax strategy, but a course on tax strategy would provide even more in-depth understanding of carrybacks and carry forwards. Shouldn't all firms lever up as much as possible to maximize the tax shield benefit? I mean, very clearly, we've just shown that you can increase firm value by using debt. The answer is going to be no, obviously not. If you think about the graph that we showed where we looked at leverage all around the world, what we notice is that there's quite a bit of variation in leverage. And why don't most firms use high leverage? Well, most firms aren't going to be highly levered because of bankruptcy. If you can't cover your interest payments, you have to declare bankruptcy, and your creditors can then lay claim to the assets of the firm. Bankruptcy can be costly and destroy firm value. And we'll go into bankruptcy in depth when we get into our next set of lecture materials. So why don't most firms just lever all the way up? Bankruptcy costs. Okay, so let's go back to our main topic, which is firm valuation. We've gone through the adjusted present value. We know how to do that. We take the value of the unlevered firm and we add the present value of our tax shields. And we can do that very straightforward. What we're next going to do is the WACC with taxes. So the WACC with taxes, this is different from the APV. With the APV method, the adjusted present value, we're treating those tax shields as if they arrive in the form of cash flows. And that's what we did in our first couple examples. With the WACC, what we're going to focus on is how this tax shield will affect the discount rate on our asset cash flows. So if we think about our firm value, the APV is all about our free cash flows in the numerator, while the WACC, it's all about our discount rate. And if we can make our discount rate smaller, we make the present value larger. So these are the two ways that we're thinking about taxes affecting firm value, either through free cash flows or through the discount rate. So let's look at the WACC with taxes. This is just like our WACC, where we have the firm's debt to equity, or the firm's leverage ratio, and the equity divided by debt plus equity, multiplied by the expected return on debt, expected return on equity. Very straightforward. The only difference between this and our original WACC is that now we're going to multiply the expected return on debt by 1 minus tau, 1 minus the tax rate. So how do we use this? We're going to apply this discount rate to the firm's free cash flows from operations, which will give us the value of the levered firm. And when should we use this versus the APV? This is going to be really helpful. The WACC with taxes will be really, really helpful if the firm is going to maintain a constant capital structure. If we're assuming that the firm has a target debt ratio that it wants to hold fixed, then it's very straightforward. So let's do an example. Your firm has a target debt to equity ratio of 1. Oftentimes, these target debt to equity ratio or leverage ratio method or leverage ratio values will be given to us when we have a WACC with taxes problem. Your firm's debt is risk-free. Your firm's assets will produce 3.8 million in free cash flows next year. The free cash flows will grow by 3% per year thereafter. The expected return on equity is 10%, the risk-free rate is 6%, and the tax rate is 40%. Okay, so we've got quite a lot of components. First, let's think about this step by step. We know that, so what is the leverage ratio for your firm? We know that the firm's debt to equity ratio equals 1. So debt equals equity. So the value of the leverage ratio, our D divided by D plus E, you can think of this as 1 divided by 1 plus 1, which is going to equal 1 over 2, which is 0.5. Okay, what is the WACC of your firm? So how do we set this up? We set it up just like our WACC. We've got the firm's debt over debt plus equity. So that's 0.5 multiplied by the expected return on debt multiplied by 1 minus tau. And then we also have equity. Again, that's 0.5 because the value of debt and equity are equal in this firm. So 0.5 multiplied by the expected return on equity. That weighted average is going to be our WACC with tax. What is the value of the firm? To value the firm, we've got to do two things. We've got to take that perpetual cash flow. So we've got our 3.8 million, and then we're going to divide that by R minus G. And in this case, our R is going to come from our WACC with tax, and our G is given to us. Note that the APV would not be useful in example 4 as the debt continuously adjusts to maintain a constant debt to equity ratio. That is, we would not be able to accurately calculate the value of the tax shield because our debt's going to constantly adjust. And WACC with taxes wouldn't be super helpful in example 3 because it's going to change every year. The assets are going to grow from year to year in example 3, while the debt level remains the same. Remember, the debt level was fixed at 100 million that was held in perpetuity. So that debt to equity ratio is going to change every year as the value of the assets for the firm changes. So the main point is that these methods, the APV and the WACC with tax, are going to be helpful in different settings. So things to keep in mind about the APV. Under the APV method, tax shield of cash flows are treated as cash flows to equity. So we've got our tax shield of cash flow, which is going to be the value of the debt multiplied by the interest on the debt. That's our interest payment. And then we multiply that by our tax rate because that's what's actually tax deductible. The present value of those tax shields when it's being held as a perpetuity, again, the discount rate in the numerator and the denominator are going to cancel right out. And so we end up with just the face value of debt multiplied by the tax rate. And that's only if the debt is going to be held as a perpetuity. On the balance sheet, the value of the tax shield increases both the value of assets and the value of equity. So this is the way the APV is going to treat this tax advantage. Things to keep in mind about WACC. Under the WACC with tax method, the tax shield is not treated as a cash flow. Instead, the tax shield benefit comes in the form of a lower WACC, which increases the present value of the firm's asset cash flows. If we have a lower discount rate, we're going to have a higher present value, and that's the tax advantage under the WACC. So APV, the advantage is going to flow through cash flows. Under the WACC with taxes, the advantage will flow through us having a lower discount rate. And when we do the WACC with taxes, we're going to use the firm's target debt to equity ratio or leverage ratio, which is typically assumed as a constant going forward. or else it's going to be hard to kind of actually apply the whack with taxes. When you're doing the whack with taxes, you want to be careful to not discount the project's cash flows if the project is not similar to the firm as a whole. So we want to make sure that we're using the appropriate discount rate. And besides taxes, the whack with taxes will not take into account some of the other advantages and disadvantages of debt, which we're going to discuss in our next set of lectures when we get into bankruptcy and market signaling. Okay, what's the big picture? The big picture is that M&M theorem was really helpful in our ability to understand capital structure. So this idea of capital structure being irrelevant unless we have market frictions had far-reaching impacts in corporate finance, money in banking, fiscal policy, and national finance all over. It really gave us a way of understanding how capital structure can be important by allowing us to see how specific market frictions can affect firm value. In conclusion, when does capital structure matter? It's irrelevant when there are no market frictions, but it does matter when we have taxes because the tax shield has value. So that tax shield will affect firm value. Therefore, how we finance the firm will affect firm value. Stated differently, how we slice up the pizza can actually make it bigger or smaller. How can we value capital structure when there are taxes? Well, we've gone through two methods, the APV and the whack with taxes, but it really depends on the situation. APV is great when capital structure is changing because we can apply the tax shield to cash flows. Whack with taxes is great if we have a constant or fixed capital structure because we then can apply the tax advantage to the discount rate. Next week, we're going to look at capital structure and other market frictions like bankruptcy and information asymmetry. That is everything.